Welcome to the Due Diligence Podcast. I'm your host, Robert Kraft, and for more than 10 years with SNN, I've been doing interviews with MicroCap management teams at investor conferences globally as well as online. Our SNN Live CEO video interviews are meant to pique interest, and then one can discover more by going to that company website. But personally, I always have more questions I want to ask. On this show, I'll be chatting with public company executives from microcap companies, and we'll dive deeper into companies that are rarely profiled. Microcap traditionally is overlooked, unloved, and absolutely never featured on legacy financial media outlets unless something material is going on. That's a good story. With my experience interviewing management teams, having interviewed most of them before, I've built up a network of companies, so there will be no shortage of content. Furthermore, this is an opportunity for me to showcase some of the qualitative lessons I've learned from guests on the Planet MicroCap podcast. You can expect high-quality interviews with management teams that may have exposure to broader macro trends that you may never have thought of. One of the many reasons why I love the microcap space. So if you love microcaps and especially love learning about companies before the professionals do, let's start our due diligence. This podcast is for informational purposes only and is not provided as financial, legal, or any other advice. The information is not investment advice or an offer to buy or sell any securities or make any investment. The views expressed by guest speakers are their own, and any reference to third-party products, services, or information does not constitute an endorsement thereof by SNN or its affiliates. SNN expressly disclaims all liability for any individual's use of the information presented in this podcast. My guest on the show today is Carl Wolf, Chairman and CEO of MamaMancini's, publicly traded company. The symbol is MMMB on NASDAQ. The company is a marketer and distributor of specialty pre-prepared all-natural foods. MamaMancini's product portfolio consists of meatballs, meatloaf, sausages, and pasta bowls with beef, turkey, chicken, and pork varieties, as well as an assortment of chicken-based dishes, olives, savory products, and salads through its T&L Creative Salads and Olive Branch subsidiaries. The company's products are sold in over 45,000 locations nationwide, including at regional delis and retailers such as Sam's Club, ALDI Markets, Schnuck Markets, Whole Foods, Publix, ShopRite, Stop and Shop, Costco, and Albertsons, as well as through national distributors such as Cisco and United Natural Foods. The company also maintains a direct-to-consumer presence on QVC and through Amazon Fresh. I've known Carl a long time and have sampled many meatballs at conferences over the years. And so I invited him on to discuss his capital allocation strategy, specifically in regards to M&A, how the company managed supply chain issues, and the specialty pre-prepared all-natural food space. And with that, please enjoy my conversation with Carl Wolf, Chairman and CEO of MamaMancini's. Welcome to the Due Diligence Podcast. I'm your host, Robert Kraft. You can follow me on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. And joining me today is Carl Wolf. He's the chairman and CEO of MamaMancini's, publicly traded company. The symbol is MMMB on NASDAQ. Carl, great to see you, man. Thank you for joining me today.
Love it. Nice to see you right before the holiday.
Right
as
before
well.
the holiday.
Let's go.
Let's do it. And as Carl indicated, we're actually recording this on Friday, April 15th. So just in case if there's any news or anything like that, they just know that that's when we're recording this. But okay. Carl, we've known each other a long time. I've eaten many meatballs at many events over the years. But for those that don't know the MamaMancini story, and we're going to go through everything today, but what would you say is that one line that best describes MamaMancini's?
Well, it's delicious product, all natural, and good for you.
I like it. All right. So as I kind of alluded to, I've eaten a lot of meatballs. I've known you for a long time. I think the first time I did an interview with you was January 2015. Wow. Yeah, I know it's been a minute, dude. We've known each other for a while.
I think you were single then, weren't you?
No, my wife was my girlfriend at the time, but it was definitely before kids. Not married yet, and definitely before 2 kids. That's for sure.
Right.
But let's get a little history of the company. You know, what was the original problem MamaMancini's was looking to solve, and how has that evolved or changed over time?
Okay, so in all honesty, the company started as a throw a meatball against the wall strategy. Our family owned a frozen appetizer company, and in 2000, upscale, in 2008, we got hit by the recession very hard. People weren't having parties, and we sold to upscale people like Williams Sonoma, et cetera. The business we were down about 35%. So we brought in an outside consultant. We looked at our line and we said the best thing we had in our line was this little product, MamaMancini's meatballs, that we were doing about $35,000 a year. So in any case, we decided to back that and support it. We started growing it, raised money, grew very slowly. It went public, I think about 2014, and grew it step by step. Very different company today than it was back then. Prior to this, I had developed with my wife a company called Alpine Lace Brands. We got it to about $200 million of retail. We sold it through we were a NASDAQ listed as well. Sold it through Merrill Lynch very successfully, and did ventures and various things between 1998 and bought an appetizer plant in 2001, built a new plant in 2004, and then we got hit by the recession. So we had history in food, and we developed a whole product line, and now we're in about 45,000 locations. We've made a very significant acquisition in December of this year of 2 related companies. We're looking at other acquisitions. We think we have a good shot at $100 million run rate by the end of this year or sooner. So our business is expanding very, very rapidly. And that's the history, but we've gone through a lot of reiterations and people, not so much people, but upgrading of our business. And what's very interesting is the industry, which is the club store and major retail chains, in many respects is back 30, 40 years. Relationships are very important. Once we get a customer to really taste our product and know of our marketing programs, we very rarely lose the customer. So it's been so the key is to keep filling in and getting new customers and getting new products into the existing customer base. So with the acquisition that we have right now, we have new products to present to our customer base, and they have some customers in their base that we don't sell. And we're bringing best practices to them, such as more cost-efficient packaging, trucking, some production activities or equipment. And in turn, they have brought us a whole line of products to sell. So thus far, it looks very positive.
Tell us a little bit more. I got some more questions on background actually, sure. but clearly that's been some of the biggest news from the company. I think that came out in December 2021. So tell us a little bit more about these acquisitions. According to the release, it's 2 premier gourmet food manufacturers. So right. Love to understand a little bit more.
So anyway, we had started in January of last year looking at acquisitions, and we had a number of candidates. Pretty much geared it up. In my early career, I worked as an acquisitions and mergers specialist. So I was very aware of the process and the due diligence needed and so forth. So we spread out a net to get what you want to do if you're making acquisitions, is you have your criteria, but also you want to have as many opportunities as practical that meet that criteria. So we had maybe 30, 40 opportunities presented to us. Many of them, the smaller ones, were significantly overpriced. And some of the larger ones were okay, but didn't have a fit. Also, we found all the acquisitions were private companies. We also found that in certain situations, they were very creative in their adjusted EBITDA, and the adjustments were like no management, no facilities and so forth. So, we had to look at what the real numbers were. And so by May, we had pretty much settled on the existing T&L Creative Salads and Olive Branch. We like them. And then in July, we signed a letter of intent, and then we closed. Due diligence always takes longer than you think. And we closed in December. So the virtue of the company is that they concentrate on a different product line than we presently sell at MamaMancini's. They're very big in chicken products, particularly grilled chicken breast in all different forms by iterations, from plain to teriyaki to Mediterranean to Italian style and so forth, barbecue. So and they sell it a whole breast or in strips. So that's a very, very big category in both food service and in retail. So that was a very key part of their line. In addition to that, they make cooked turkey breast, and they have a whole salad line, which they sell to some supermarket chains, but also sell to a local trade. They have local trucks, and they sell to a number of distributors who sell to that trade as well. So that represents about 25% of their business. And we now are looking to take some of those items into MamaMancini's customers and hopefully sell those products. Plus, we'll be presenting, I think, at the end of April, the first QVC item that is from T&L, but there'll be many, many more items. So it's been very good. We have already announced 4 new items going into BJ's, a very large club store chain on the East Coast, and those are derived from T&L. But we have many more items coming from T&L into many more chains. So it's been a very significant potential increase in volume. Takes time. And in turn, T&L is now starting to buy products from MamaMancini's and selling to their trade. Their first major PO purchase order just came in yesterday, in fact, for a nice amount of volume. So the cross opportunities in selling is very, very positive for both companies. What also is very positive is that we've been able to resource significant savings in packaging for T&L Creative Salads. And we are also resourcing some commodity items as well, which we think will be very helpful. And trucking is very helpful. So we've been able to potentially lower T&L's cost, increase sales, both from MamaMancini's and T&L. We're now inviting T&L's production people over to visit MamaMancini's to see if there's any best practices that they can reflect. In addition to that, we're looking at a number of labor-saving equipment and pieces for T&L, which our key management person, Matt Brown, is actually there today. So it looks well. What we haven't done yet is fully integrate their accounting system with ours. We've just implemented NetSuite. We're still in the learning stage, but if all goes well, by the middle of the year, we'll move NetSuite into T&L as well. And we'll have a similar set of accounting numbers. So that's positive. And as I mentioned before, we are looking at other acquisitions as well.
Hey, Carl, I wanted to ask about that because, I remember seeing that release. I think you put it out. I think you just said January 2021 that you were looking at that. What were some of the reasonings behind, publicly announcing that the company is looking at acquisitions?
Oh, because you wanted to. Absolutely. We got a number of inquiries, and basically you have a network,
Sure.
and then we use PitchBook to identify a number of potential companies that we contacted. But I think it's a little more economical in terms of purchase price if someone is looking to sell their business. So what was the criteria? We were looking for companies that established a nice business, but in a local geographic area or limited. So their products had proved themselves, and they had an operating procedure and costing, and they were complete businesses, but had stalled on sales because, for whatever the reasons, management got tired, family, a whole host of things. So those were the type businesses we looked for, and T&L fit that criteria. It was basically a New York metro company with some national accounts. So that was the first criteria. The second criteria was profitability, had to be profitable. Third criteria was we had to have certain key management stay, because we were not going to go in and run that. So, and we've had that. In the case of T&L, it was a family, and other members of the family wanted to retire. So that worked out. Thus far, seems to have worked out very, very well. The next criteria, of course, was to be in a growing segment of the industry, and our key business is selling to the prepared food sections of supermarkets, and that is growing very rapidly. If you go to our deck, you will see a whole section on that section of the store is growing 8-10% a year. So it met our criteria. Then, of course, price. So we would very much hope that the acquisition would be accretive. If it wasn't accretive, we weren't looking to buy. There's a lot of opportunities. So we've completed our first one, and we're now looking for others. But as I mentioned before, we're expecting to do very, very significant volume in a year.
So how are you thinking about the brand as well when you're thinking about these acquisitions? Because MamaMancini's, it's traditionally been Italian cuisine. Is that something that you keep in mind? Like, all right, we want to look more for these things, or are you just looking at any type of value creative opportunity?
Well, some of the products we go right into MamaMancini's brand,
sure,
such as Italian grilled chicken,
right,
or Mediterranean grilled chicken. That's a very, very big item. And then we're developing a whole panini line, which is Italian. So and olives are definitely Italian. So there are segments of their business that are very, very Italian oriented. So we have a new item, meatballs in a cup, which it's a little early, but it appears to be very, very well received. We sold that on QVC and 2 times. And the response has been wonderful for it. So T&L now has a number of customers, airline customers, who are interested in buying that product it's a high protein snack, which there's a segment of the market that wants it. So if you're on an airline trip and they're not giving you food unless it's first class, and you have an afternoon snack you want to give someone, or another snack, and then you can get a candy bar or get a meatballs in a cup. There are a lot of people who are going to want the meatballs in a cup.
Right.
Low cal. The whole 7-ounce portion is 230 calories, 15 grams of protein. Has antioxidants in the sauce. So so the synergies are there. And opportunities, and it seems to be going very, very well.
Hey, Carl, for those who aren't familiar with that, haven't been following the story for as long as I have, or known you as long as I have, what would you say were some of the inflection points that got you to where you're at today, where now you're expanding the product line, looking at various acquisitions?
So in the mid-teens, up to about 2016, we were very, very much trying to sell a frozen product in a branded box. And there was slotting fees and a lot of promotional and merchandising allowances. And you'll see in our deck also, we have 92% intent to buy again, which is phenomenal. except in the frozen section of supermarkets, in the meatball section, you have a customer that is very price oriented. So while they loved our product and we had great, great reviews, when the next product was on sale, it was very promotional oriented. So over time, it really wasn't a profitable business. It was a good sales business, but very unprofitable. So we were in the process of raising about $15 million to further develop the brand, and through a banker, whose name I'm not going to mention, but we did everything, the whole package, and the deal collapsed in the last few days. So we didn't raise anything, and that was an inflection point because we had $500,000 in the bank, and we were losing $300,000, burning $300 to $350 a month. So we had about a month and a half on the very short term, and we knew the deli part of the business was very profitable. So the inflection was we got out of the unprofitable business, moved towards the more profitable. We raised we found some capital to raise, got the company to break even by the spring, and from there we went on to profitability. So that was very, very important. So we're branded within the deli case. Also, we've developed a very, very positive line selling to club stores a large economy pack. So we sell Costco. We're now in a major rotation at Sam's Club, where we're in their bonus book or coupon book nationally, going to millions of consumers, and that will be good for the month of May. And we start BJ's in August with our branded 3-pound pack. It's a jumbo meatball, and whatever the reasons, a jumbo meatball tastes better than a smaller meat. Not that the small meatball is bad, but the jumbo meatball is great product. So I think that will continue to expand. And I think that it's very early to say, but that meatballs in a cup is the grand slam of all grand slams of products. It's branded, and I mentioned it had all these various attributes, and we can sell that product in convenience stores. There's over 100,000 of them. We could sell it in supermarkets, grab and go. We can sell it on QVCs. We just sold it. Sports venues, transportation hubs, colleges and universities, corporate feeding, multi-pack in club stores. So there's all sorts. So we're talking about, if we do reasonably well, way beyond the volume that we're doing at present, just on that one SKU. Very early. We've taken it very slow. There's been some technical issues which we solved in the packaging. And again, we'll be getting our first convenience store orders in the next week or two. And then we'll test there and then roll out, because we think it's too valuable. We could get more business to begin with, but we want to make sure that what we think are the virtues of the product and that it sells. So if we sell a couple hundred convenience stores and we have some issues in terms of packaging or quality or whatever, that we can solve it and not destroy our business with the rest of the potential trade. So there is a lot of tweaking to do, et cetera. But anyway, we're very, very hopeful on that product line. I think, it's a game changer for the company. The other product line, so we have a club store family pack. We have meatballs in a cup. We have what we call pasta bowls or meals to go. And now we've added, and there what we do is we sell a kit. Think of Blue Apron. We sell a kit to the supermarket chain. The elements of the kit are frozen. So the soup and so it has a shelf life of a year. The supermarket chain takes the kit, defrosts it for a day, and then builds 4 per sub box. They build 4 pasta bowls, or in certain cases they'll build 2 for a larger pack. Each one weighs about a pound, and so they put a layer of pasta a layer of sauce, a protein, more sauce, and then cheese. So all that's in the kit. And as a result, when you purchase it for in-home eating, it's very fresh versus other type products. There's a product that's shipped refrigerated that has 75 days. The product does hold up in terms of pathogens. However, if you have sauce sitting in product with pasta or whatever for long days, everything melts together. So you lose flavor profile. So we have another product which you just started selling in January, where we put together the kit and then flash freeze it. It goes to the supermarket chain. It defrosts in one day, and then they put it out on the shelf. And that product is starting to pick up a lot of business. So those are, aside from growth of our existing product line in new areas and so forth, and new customers and the cross sales through both companies. This is a very rapidly growing area. So we have started to get some very, very significant commitments, and I think we'll be getting many more. The advantage of the what we call meals for one is that labor in supermarket chains are tight, so they like a product that isn't, first, it's the product quality is very high, so they're not compromising their quality. So that was one of the issues we had in the past, was by making this product a la Swanson dinners, which everyone remembers or still is around. You have very mediocre quality. So the key was to have really, really high quality where they didn't have the labor. So that is in the process of growing. In fact, we're thinking that we'll be outstripping our capacity and figuring out how we go the next phase on that. So things look very, very good. That's very positive. What's been an issue has been the very, very rapid increases in inflation. So
I was just let me set you up for that, because I know, clearly in 2020, many companies face challenges. I'd say for MamaMancini's, the number one challenge was the deli line, right? Because that just wasn't open, right?
Right.
That you've rebounded since then, but now the new challenge coming up is with supply chain. So maybe first, how you handled that challenge from 2020 with deli and how that's opened back up, and then also now the current challenge with supply chain and inflation.
So in 2020, although the traditional deli closed and the hot bars closed, we had business with the hot bars. We sell Whole Foods National. So Whole Foods moved from the hot bar to a grab and go. So basically most chains went to grab and go when they closed the hot bar or they closed the deli. So we had business there. And the other thing that happened is club stores got a much higher percentage of business, and we sold club stores. So we held up very, very well with that challenge. The issue right now is that protein prices, chicken, beef, to an extent pork, now turkey, have all risen beyond the highest prices that they have ever. And by chicken, I'm talking about a chicken breast, whereas whole chickens are up, but not nearly as much as chicken breast. Why are chicken breast up? Just aside, because of Popeyes. Popeyes, the chicken chain, had a major, major increase in business when they went to a whole chicken breast sandwich. And now McDonald's, Burger King, Chick-fil-A, everyone has followed. Even now, Panera has one. So as a result, the price of chicken breast, whereas in the past, when you ordered a chicken breast, let's say from Burger King, you had white meat. Was potentially pressed together. There wasn't one single premium piece. So you have chicken tenders and other pieces that are the back part of the breast. So this is the heart of the breast. So so as volume has dramatically increased, that demand has skyrocketed. So the price of chicken breasts have gone up around fourfold in the last 18 months. The price of beef has just about doubled. Ground beef has doubled. Pork is not a major element. And right now, turkey is just, there's a bird flu, so turkey prices. So that has been an issue, and the old rules are changing. So, an example, in our olive business, olives have gone up modestly, but the price of oil, I'm talking about olive oil that you put the olives in, has gone up tremendously. The price, almost all the olives are sold in a plastic package. You've seen it where you pick up the package. Well, the price of that plastic package has gone up dramatically because of oil price. Plastic's made out as a derivative of petroleum. So we're faced with, and then price of freight has gone way up. So all of that, plus flour now has gone way up for the pasta elements. So we've been facing very, very major price increases. And the feeling was that by the fall, where they were already very, very high, that they would back off. Well, they haven't. They stabilized and then started going up again. And now they stabilized and started going up again. So the new rules are totally different from anything in the old environment. So our view is you have to get price increases through. If we get price increases, we have to give price increases. We can't wait the normal amount of time to implement it. So we're moving very, very rapidly with that and our margins. So we've had some impingement of margins, since September, and now we're starting to correct that, and we'll see more. But our view is, whatever happens, we have to pass on, and we can't worry about it. So it's a whole nother philosophy. Whereas in the past, you would say, I don't know whether I should put the price increase through, will it hurt my volume, et cetera. What's very interesting is that people like Canavera and others are saying that the price increases they've put through thus far has not affected unit demand. So,
that's interesting.
So I think there will come. You have to remember that there's $2 trillion of additional savings in Americans' account right now than there was 2 years ago. So it's a lot of money. The economy is $20 trillion. Yeah. So there's a lot of money still backed up. So if you received $8,000-9,000 in government subsidies and you're getting $3,600 per kid in subsidies, and got extensive unemployment where one spouse really wanted to work, you add it all up, it's a lot of money. Plus you have inflation. And if your home was worth $300,000 and now it's worth $390,000, and you had $240,000 mortgage, you just increase your net worth from $60,000 to $150,000. And if you had an IRA worth $40,000, it's now worth $60,000. So the typical net worth of homeowners, especially when you have, and the savings they have, et cetera, is up over 100%. So even though there's high inflation, the consumer thus far is not backing off. They're continuing to purchase because they now have so much more net worth and value. Plus, if they feel, even if they are eating into their savings, et cetera, they feel they can get another job. So people are grousing and upset, but they're continuing to purchase in the same manner. So we can't control it. So the old rules are gone. Yeah. So we have to move ahead, and whatever pricing comes into us, we have to push forward. So we expect our margins, if we're going to be running at 100 million rate and our margins normalize to 7 to 8% operating profit, you're talking about a $7-8 million profit. If, again, these are, there's no guarantees, but these are goals for us. But you have a company, with 36 million shares outstanding. You're talking 20 cents a share pre-tax. So there's a lot of value, in the company's trading at, a modest price right now. So there's a lot of potential value in the company.
Absolutely. I asked this to every company on here, and you've kind of addressed it already a little bit here, but in your opinion, what would you say are some of the downside risks right now when you're taking a step back and you're looking at MamaMancini's as
for us or for everyone?
Well, isn't it both?
Well, for everyone, for us, it could be that what is relatively high inflation just becomes super, so that it is so fast. You have to adapt to such rapid changing, a la Venezuela or someone else, which I think is very unlikely. I think there will be resistance developing. At least a segment of the population will resist because that segment doesn't own homes or their equity didn't go up and so forth. So there will be some impingement of demand, but there is a risk that you could have hyperinflation, and then it means we have to scramble to absorb that, which means if there's hyperinflation, literally you have to raise your prices every week. So you have to put that installation in and also have enough inventory to cover you for that week. I don't think that'll happen, but that's a risk. The other risk is we have several very large, we have about 8 large customers, and you run the risk of any of them of losing that business, et cetera. And then there's another risk in which we're dealing with, which is adding to our management as we grow and as we make more acquisitions, et cetera, and become a larger company. You definitely need another structure in the company.
So, Carl, look, I think anybody listening, watching, and again, that's even extremely passively followed MamaMancini's, like that, you can almost, it's just always been one word, meatballs. Like you just know, oh, meatballs.
Right.
But what would you say investors, from your conversations, going to all these events over the years and having your investor meetings, talking even with the board, what do folks still misunderstand about MamaMancini's?
We really are a full Italian line, and there's a lot of pasta and sauces involved in it, and that will continue. So as we expand, example, we have authorized at Albertson Safeway 12 different what we call pasta bowl lines. Now, each division doesn't handle it, and we're rolling, and they're not in all stores and all divisions. They're converting stores. So what is modest-sized business now will become a tremendous business within a year. And they will start taking on more items. So an example, we sell Publix 5 pasta bowl items. Publix our number 1 customer at MamaMancini's. So we just presented 4 more items, which are non-competitive. They don't have that item on the shelf. So, and that's the grab and go section. They're expanding their grab and go section because, it works for them. So it really is our meatball part of our business is becoming smaller as a percentage of sale. We're getting new meatball business, but the major growth is now in other products.
Got it. One of my goals for today's interview is that I really wanted to try and make you laugh. So here's my attempt at trying to make you laugh right now. I think the last event that I saw you back in 2019, you were doing the meatless meatballs.
Yeah.
What would Grandmother Anna, Grandmother Mancini think about the meatless meatball?
Fair. Our product, actually, our meatless meatball, is probably the best in the industry because we have to grind it several times. We had a number of ingredients. We maybe have done about 100 recipes on it, and finally come up with one that's pretty good, very good. The issue you have, though, is that for us, the meatless product really didn't make it with consumer demand. As we're selling some, but it's not running off the shelf. And I think, if you look at the numbers of some of the major meatless companies, they're having some issues right now. I think, everyone got in front of themselves and it hyped too much instead of, an evolutionary growth. I do think there's a market for vegetarian meatballs that will continue to grow. Also, there was a very, very, on the meatless product, there was a very big negative news put out mainly by the cattle people about how overly processed the product was. And they really had to come out with a totally natural product So when you read the ingredients, that was tough, and they appeal. People are going to buy the meatless meatball, which is much more expensive. Meatless beef, it's much more expensive than ground beef at the time, even much more so back then. They are more educated, and they were people who read labels. And so that the people read the labels and rejected it. So, example, I'm in Florida right now. They took off the meatless burger because it didn't sell. It was selling okay, and then it slowed down to nothing because there's just this view that the product is too processed. I think.
Yeah.
If you want a burger, eat a burger.
I mean, that was kind of like, my wife and I, when we were looking, we were like, I'm not talking about specifically MamaMancini's meatballs, but just in general, we're like, I don't know. It seems like there's so much.
Oh, it got a bad rep.
Yeah.
We didn't handle it right. There's not enough virtues in it.
But I will say, in fairness, when I did have the MamaMancini's meatballs with the sauce, it was very good. I was eating it all day. Full disclosure, I'm not a shareholder. I just enjoyed the meatballs with the sauce. So it just okay, good. See, look, I made you smile. There we go. All right. So, Carl, from a corporate perspective, there's been some new additions to the board. I've known Connor a long time as well. I've interviewed him for Planet MicroCap many times. He's presented our events. So what was some of the reasonings and this kind of, I don't know if it's a restructuring necessarily, but some of these additions to the board that you've seen that the company's experienced in the last year?
Okay, well, the original board we had that was still on are people I've known for, two of them I've known for a long, long time. I'm talking about the outside directors. And they are very heavily related to the supermarket business in the New York metropolitan area. From them, there was another investor who was the CEO of ShopRite. Supermarkets, a very big supermarket chain. So we had three people on our board that were very New York centric, New York retail centric. We had management, Steve Burns, Matt Brown, and myself. And I felt I wanted to bring some outside people into the board. Connor Haley, his company, Alta Fox, owned about 5% of our shares. And he was interested in being on the board for a whole host of reasons. And so he's been very active as a board member. And it's given us a lot of insight. In fact, we had a board meeting earlier today. Mike Stangl was the head of all events or conference centers at Marriott. So that represented about a $2 billion business. So he had extensive background in food service. Plus, he's a very smart man. Both of them are very smart. So we have new input. And when you have less of a club, people who've known each other for a long time with some outsiders, you definitely have a much better discipline in the board. So I think it was necessary and very beneficial to the company.
Very good. All right. I only got two more questions for you. So my next question for you now is, in 3 to 5 years, where do you see the business going? From what you can tell us, of course, but where would you like to see it? And what would you say are some of the other catalysts or inflection points that need to happen in order for it to get to where you want it to be?
I think we'll be a several $100 million company with some acquisitions, which would be very significantly accretive. I think we will increase the management's capabilities. We'll be adding to the management staff. I think, quite honestly, I'll be, no longer in an active operating role in the company. It's needed. Founders are great. I'm I think a great entrepreneur, but now you need people who are more everyday operations, et cetera. So I think we need some of that. And I think our margins will be up there, in our stock value, if all goes well, et cetera. Our stock value could be significant multiple of what it is now. So all, I think, relating to very similar products in fresh goods. I don't see us going into the frozen case. We may, it's a great opportunity, but that's not our first priority. The fresh goods area is where the growth is in the supermarket. It's interesting that the same customer who goes in the frozen aisle will wear blinders into pricing versus they go over to the prepared food section and they just say, $8.99 for a meal. I have to cost me $15 or $18 at a modest, now it's more, $25 at a modest restaurant. You pick it up and it's an alternative for it, whereas they go in the frozen section and they're looking at, everything, they're only buying on what's on promotion. Same thing has happened in the grocery aisle, which was relieved for 2 years because of COVID. So people were, buying up what they could, but that has been declining consistently. So it's been very, very hard. So people like Kellogg's and General Mills, et cetera, have moved toward more price promotions. I don't know if you understand how the category manager works at these big brand CPG brands, but basically you have goals of hitting certain sales and certain marketing dollars. So you can decide how you spend your marketing dollars. So if you're off by 1-2% your sales for the quarter, you're going to move over to promotions rather than other types of, there's a million different types of marketing tools you could use. So as a result, there's been more price for it. Now everything is out the wall right now, short term, because there's supply chain issues. So you can't get the cereal, the cost of grain is up. So they're just finding product and raising prices. So eventually this will all settle down. But so we're in the right section of the supermarket. We will have more growth of our own and more acquisitions and more products. We've been interviewing key management people, and we have 3 areas to grow: internally, what we have, innovative new products, and acquisitions. So all 3 things are happening with our company, and that's what we're doing.
Very good. Well, Carl, my final question for you today, and
really,
I swear it's the last one. We got a lot to eat today. It's Passover for us.
Right.
So to close us out here, do you enjoy being a public company CEO? What's been the experience been?
Well, I like the tension, although at times it's nerve-wracking. But there's a certain tension of performing. The biggest issue is quarter-to-quarter analysis and making your quarters. So we're very careful to not really give significant guidance because a lot can happen. So we give overall guidance for the long term and feel comfortable with that. But I think that's the biggest problem, that people live from quarter to quarter as a public company. But other than that, I think I don't have any complaints. It's a vehicle to raise capital, and it's a vehicle one day for us to, get some equity into our families.
Now that's a great place to end it. So, Carl, with that, where can our audience go and find more information on MamaMancini's?
You can go to our website, www.mamamancini's.com, no apostrophe S. And go under investors. And there's a investor deck on there. And there also is, you can go to reports. There's a very complete report written by Taglish Brothers. Also, we have sales literature on there, and you can hit and a review of all our products. You can see them to get a review of them. You also may want to go to the QVC page where we have had extensive presentations. We just were on Wednesday with 2, with the meatballs in a cup and cocktail meatballs. So
you guys are on QVC more than Laurier Grenier at this point. I mean,
I think we are. We're considered one of the top QVC items, and we are. We won several awards at QVC. We won best sauce, we won best brand in the food industry, and we won best meatballs.
It still works, huh? QVC.
Yeah, QVC is very. Actually, when COVID started, QVC sales increased very dramatically, and QVC works. You can find ways to buy product a lot cheaper than QVC. However, most of what we make for QVC is in a unique package for them, so they have some distinction. But it does work, and there's a segment of the population that wants convenience delivered to their door, etc. So QVC does work. They're in over 100 million homes. So, yeah. And we're one of the top performers of all their food lines.
Well, Carl, with that, thank you so much for joining me today. I really do appreciate it. Good luck. Stay safe. This podcast is for informational purposes only and is not provided as financial, legal, or any other advice. The information is not investment advice or an offer to buy or sell any securities or make any investment. The views expressed by guest speakers are their own, and any reference to third-party products, services, or information does not constitute an endorsement thereof by SNN or its affiliates. SNN expressly disclaims all liability for any individual's use of the information presented in this podcast.